Good morning, traders. Today is the 29th of November. My name is Neville Hornsey, market analyst for YouTrading. And today I'm joined by
Joel Frank, also market analyst for YouTrading.
How are you doing, Joel?
Yeah, I'm good, mate. I'm good. It's getting chilly. Did you get any snow your end?
No, frost. But the kids
Ah.
still went around. You can just see cars being like scraped, just like
Oh no,
making like tiny little snowballs and like words. No, it's proper frosty. So yeah,
yeah,
I think that's the first one I've seen this year. So, yeah, but
yeah, same. We were thinking last week, weren't we? Do you remember we said in the podcast that Thursday and Friday were going to be really quiet, Thanksgiving, it's going to be an easy end to the week. Wake up on Friday, check the news, and I'm just like, oh, geez, what is going on?
Yep, exactly.
Omicron, and then apparently, according to financial markets, the whole world was ending on
Yeah.
Friday. But
yeah. No, it was a nice catalyst for a good sell-off.
Yeah, it was.
But I was trying to sort of say that on a bank holiday, thin markets is one thing. A long weekend, again, Friday was kind of thin markets, but volatility is like, you can just see lots of moves, expand the ranges really quickly because there's just no one there sort of hitting the bid or like taking the sort of offer. Or, it's just one way of doing it. And it's just a good catalyst, wasn't it, that news event?
It was, like you say, perfect storm, catalyst that could potentially change the global economic outlook. Comes on a day where, like you say, thin liquidity, and then you see these over-the-top moves, which is pretty much. So we're seeing a bit of a retracement today of the big moves last Friday. So like stocks a little bit higher, dollars a little bit higher, euros a little bit weaker. Crude oil is like 5% higher. Look at that, more than $3 back up now.
Yeah.
So yeah, I think it's kind of cooler heads have kind of returned a little bit on Monday. And also we were just saying this before we started recording, but like some of the news out of South Africa from the doctors that have on the front line of the Omicron outbreak in South Africa, they're saying that the symptoms so far are very mild. So there's a potential that like I was saying a second ago, if this is a very mild virus, it could sweep the world, but highly transmissible. It could sweep the world, give everybody immunity to COVID-19, but without, filling up the hospitals and everything, which could then mean that, we end the pandemic in a way. Yeah. That might be a bit optimistic.
No, definitely. And I guess it's just a massive unknown, and that's what the markets do not like. It's like they don't like unknowns. They like to have some sort of idea what's going on.
Yeah.
But just like looking at say crude oil, if I just share the screen.
Yeah.
If we go to the Brent, that big sell-off, there's been a build in the oil inventories in the US for quite a while now. So it just seems to be, OPEC's going to be, we're supposed to be having a meeting, and now that whole SPR type scenario, and now this possible demand sort of reduction across global sort of markets. It'd be interesting to, it just seems to be like it all was a perfect storm. Like everything was all happening at the same time, and now everyone's got to readjust their sort of expectations and their thoughts about what they're going to next move's going to be. So like the Fed, are they going to, because the whole talk was they were going to speed up the tapering and things like that so they could get on with this rate hike. But if Omicron is going to go around the world, like you just said, then there might be a global contraction as such. So
I think we haven't really heard the reaction of Fed members to the latest developments with Omicron yet. We're going to get that this week, which will be an important theme, like the Fed speak. But I don't know if you heard what the ECB lot were saying, but they were kind of thinking that I can't remember who it was that said it of the specific ECB members, but they were saying how they think the economy is already quite well adapted to the pandemic now, so that this new wave, even if it is quite severe and it does increase hospitalizations, it's not going to affect the economy as much as past waves. And the general vibe that I was getting from most of the ECB people was that they want to press ahead with ending the PEP, the Pandemic Emergency Purchase Program, in March anyway, like regardless of Omicron. So if that's what they're sounding like, potentially the Fed might have a similar sort of tune.
Yeah.
But like you say, it's early days. We don't know how much vaccine like escape there is with Omicron. Is it going to be putting loads of vaccinated people in the hospital again? Yeah, we don't know. It looks like the symptoms might be quite mild, but the sample sizes we're looking at are still very small. How's it going to look when it comes to developed markets where people aren't like, a bit older, less healthy and stuff? There's so many unknowns.
Yeah. So, and I guess like we have to go to like the markets and sort of see what they might be thinking. So, in terms of like risk on, risk off, I believe if the market is buying into, say, like the long bond ETF, like this TLT here, then they're sort of being more risk adverse. So if they're moving into something that's like a safe haven, sort of, parking your money somewhere, government is going to look after it, then you kind of have to expect like the S&P equities to come down. And did you see that thing on is it Zero Hedge that JP Morgan were like predicting a 40% reduction in the S&P, so it'd be coming down to like 2,600 or something.
Were they?
Yeah. So like I mean I don't personally think that's true. Like I don't, but but that's quite a bold. They were just basically saying if the inflation stays as it is, like high, and their sort of metrics basically worked out to be around a 46% reduction.
Wow. I'm not sure about that personally because although I know what they mean about the inflation staying high, because think of it this way. If there is another wave of Omicron that causes global lockdowns and is massively disruptive to the global economy, well, then it's going to exacerbate those supply chain disruptions that are already pushing up inflation.
Yeah.
So then inflation is going to potentially go even higher, or at least it's going to persist at elevated levels.
Yeah.
And then if central banks then use that as an excuse to stay more dovish, well, then that's going to feed into rising inflation expectations and all that kind of stuff. I don't think fiscal, like the fiscal authorities, the governments are going to be willing to splash as much cash as they have been in the past because of inflation. They're worried about that. Like they're not going to give out stimulus checks in the US again, because like not when inflation's near 7%.
Yeah.
But yeah, like inflation, this could be very inflationary if it is quite a bad outbreak.
Yeah. So for anyone that's trading and such, so this is what I did wrong last time we were at all-time highs, and then something crazy happened called COVID. So I was buying the dips on the DAX, which is a very, very good move for a long time. And we were buying we were saying we were to buy the dips on S&P 500 when it was getting it was getting down to like the 50 EMA and things like that.
Yeah.
But what I did wrong last time was buy the dip, and then when COVID came, I still bought the dip, but obviously it just maxed down. So looking,
so you got stopped out.
Yeah, very much so. So looking to like the market structure at the moment, we've still got like a couple of percentage to go before the DAX does that sort of same, take out that sort of major sort of structure.
Yeah.
And then if it holds below that, like it did on this day, then that's the time when I think the markets are signaling that this is coming down a lot lower. And the same for if we go back to the S&P 500, it to me has actually done a bit of damage to that sort of structure. So we had like a move up, pullback, higher highs, rejected those higher highs, and then that big sell off. So if this can get back above, then we just had a little look below, and now we're going to go and sort of test the highs again. If they can't get this to stay above, this week, because we've got loads of things coming out. We've got ISM, we've got the NFP, got 3 lots of Fed Chair Powell speaking. Got all sorts, so if they can't get back above that sort of line by the end of the week, I think we'll be a lot lower. We'll be down here at least. So
I see what you mean. But I think a lot of it is going to depend on what new information we find out about Omicron by the end of the week, pretty much. Like, I mean, it's going to be a couple of weeks probably until we really know how effective the vaccines are against it, which is very important. But I think more news is going to trickle in about how severe the initial infections are, and the market's going to be quite reactive to that. So I still have a feeling. I have a feeling that things could turn very risk on if it looks as though the symptoms are going to be a lot milder than the COVID that we're used to.
Yeah.
So that's one of the things I would say is really important to look out for. They're probably more important than anything else. Obviously, Fed speak data in the US, like jobs data and everything, that's still all super important as well.
Yeah.
But yeah.
So what else is on the calendar that we should be talking about?
Let me pull it up and have a little look. I can't even remember now. I mean, it's mostly about the US, to be honest. We've got a couple of Bank of England speakers, which, you know, we've got you've got the Bank of England meeting coming up this month. Markets are still kind of umming and ahhing about whether they're going to hike 15 basis points, kick off the rate hiking cycle or not. I mean, the Bank of England, when the policymakers speak, they haven't been very clear about that at all in recent weeks.
No, they've kind of lost credibility with the markets for the time being, haven't they? So
that's very true.
They kind of need to actually do something rather than just talk about doing something.
Yeah,
or just come out and say we're not going to do anything, and then everyone goes, "Okay, thanks for telling us." Just like
It's what they've done. I think potentially this is the biggest problem is they've kind of. It's okay for a central bank to say they're not really sure what they're going to do, but then when they say we're not sure what we're going to do, they have to say, therefore we are data dependent. And if the data starts to look like this, then this is how we're going to react. And if it looks like this, then this is how we're going to react. But nobody really understands what the Bank of England's reaction function to the data or to, you know, global developments or whatever is going to be. They haven't been very clear about that.
But I think you could say that about the Fed, because when the last FOMC sort of meeting had its press conference, Fed Chair Powell asked, okay, so what does maximum employment look like? What is the framework? And he was just like, you know, we're going to look at this bit of data, you know, like look at all the different bits of data, and then we're going to come up with, you know, like a consensus view. Yeah. And like they kept on pressing, saying like, yeah, but what is the number like of all these things? Like if we would just put it into an equation and we popped out a number, what would that number be? And it became like almost like just a feeling, like when they feel that, you know, because they don't really understand what the job market is going to look like, because obviously participation rates down, and it might not ever go up to like pre-pandemic levels and such.
That's
so
the thing.
They don't know. They can't come out and say, I don't know.
Well, because the thing is, if they could come out and say something, but then they'd be tying themselves down to something. So that they kind of were doing that, like a couple of, even as recently as a couple of months ago. Like, you know, when they created their new framework, the what's it called? Average inflation targeting, basically.
Yeah.
And that pretty much, it was very heavily focused on how we're going to let inflation overshoot, and then we're going to allow the unemployment rate to drop lower than we have in the past, because in the past we thought we were at full employment when actually we weren't, because it wasn't creating inflation. And they used to put a lot of emphasis on getting unemployment rates within minority groups as low as possible. But the problem is they're trying to reduce the emphasis on that now, because what happens normally is you get to kind of, you know, 3.5% unemployment or whatever for the general population, and then you start to see these drastic reductions in the minority communities unemployment rate. It comes later, but the problem is they've got this big inflation problem where they're probably going to have to do a trade-off now, where they can't wait that long to let the unemployment rate drop that low, because inflation, who knows where it will be if they just refuse to ever hike again, practically.
Well, I was just looking at the dollar yen, because that had been tracking the sort of 10-year yields, and, you know, the sort of like the more short-term yields, and that had a big sell-off obviously last week, and it came down to this sort of little demand zone. So I'd be interested to sort of see if the TLT keeps going higher and the dollar yen comes down as Fed Chair Powell speaks over the next 3 days, you know, through his testimony and stuff, because that would be the market saying, all right, yields are coming down. Just like they're not going to raise rates just yet.
I mean, it's a week which could go in a lot of different, like you said, there's a lot of uncertainty at the moment. Things could go in a lot of different directions depending on how the news with Omicron goes. I think that's the key thing.
Okay. In terms of like that, then which market should we be looking at to sort of give us an indication of what the rest of the market's looking at? You know, like the sort of bellwether, the sort of canary in the coal mine type thing. If one thing moves, which one should it be that we watch? do you think?
I think it's going to be Fed rate hike expectations, and one of the best ways to gauge that is going to be looking at potentially the 2-year yield,
Okay.
which saw on Friday, I think it saw its biggest drop since like 2020, in March.
Mm.
Short end yields obviously are of very, they're a good gauge of expectations for Fed rate hikes in the
Yeah.
next 2 years. So if we start to see that pushing higher again, that's going to be reflective of the fact that markets are going, you know what, the Fed's still going to hike. Then you're going to see the dollar coming back. You might see equities coming back as well, because equities will be like, okay, we're going back to how we were feeling before, which was kind of quite risk on, optimistic about growth. Yeah, the Fed's going to hike, but they're not going to be super, super aggressive.
Yeah. Yeah. Because
So
going back
that's
to
what
that,
I would think.
yeah. So the 2-year and 5-year sort of yields, that had definitely been
Yeah.
sort of lifting the dollar itself, like on the dollar index, like we sort of see here. And then, yeah, that big sell off in the short term yields, and the dollar sort of just crashed through, all of last week's price action, basically. So, but at the same time, it still hasn't sort of broken the bullish structure. So we've got to 95.50 on my book, to sort of, if we get through 95.50 and then get back down towards 94.50, then we could be in a worse place coming forward. All right. Anything else you want to talk about, or should we just?
I think that's it pretty much. Like, we got a few other things worth a mention, would be like Canadian jobs data for the loony traders. Obviously, we did mention OPEC already, but just they're probably going to stop increasing output amid all the uncertainty.
Yeah.
Aussie GDP. I mean, we know it's going to be bad because they had the lockdowns there in Q3.
Yeah.
That's pretty much it, to be honest.
Yeah.
Eurozone's preliminary inflation. That's going to be worth watching.
Yeah.
So what we getting that starting today, I think, aren't we? Like
Yeah.
German numbers and stuff.
And just talking about Europe, I noticed that on the monthly chart, the price action had come down to sort of like, say, the sort of 200 period moving average here. So could be in for a bit of a bounce. It kind of all sort of coincides, doesn't it? It's amazing how they get all the technicals to line up with a bit of fear.
Yeah.
Yeah.
I mean, the thing is, the technicals were getting very oversold for the euro, weren't they? It just been getting battered day in, day out, day in. So it is due. There's shorts that need to take some profits. That was a good opportunity to do so. Yeah.
Yeah. All right. Okay. Well, we'll see how this new variant pans out. See how much craziness the markets take from all of that.
Nice.
Yeah. And I hope you have a great week and stay well. So yeah. Speak to you
soon,
next
mate.
week. Yeah. Cheers.
Okay.
Bye.
Bye.